We're gonna show you how we run numbers, but more importantly, how to look at these properties from an investment. A lot of people get caught up in the, let's just call it cash on cash. Cash on cash is super important, but there's other benefits that are important, financial benefits that you're aware of when you purchase these properties that a lot of people aren't. So let's show you how we break down the numbers. So first and foremost, this property, 110 Shell is projected, I think, at like $260,000. So step number one is to take the rental history or the rental projection with a grain of salt. A lot of these properties are under rented, they have a lot of owner use, and you tend to see property managers erring on the conservative side of these properties. A good example is I have a house in South Forest Beach, very close to this one. It did $270,000 year one. At that time, I went out and I asked the rental managers, some of the best ones on the island, hey, can I get a projection? And the highest one I got was $190,000, not including their split, and I was sitting on my property at $275,000. Guys, that's more than $100,000 difference between self-managing it and running it correctly the way we did and we help our clients versus you use a rental management company. There's pros and cons to both. We'll talk about that. But the biggest thing first and foremost is we have very advanced softwares that really show us what these properties can do if they're running at their maximum potential. So 110 Shell at 58% occupancy. That's low occupancy. You could even pull the occupancy up and the nightly rental rate at $14.39 on average down and still do very good numbers on this property. But here's my point. $304,000 is really what this property should do. Again, ours is a 6-bedroom, older, it's doing $275,000. This is a 7-bedroom, brand new. So we're gonna take this number and use our scenario today. So first and foremost, make sure you are looking at all of the picture. When you engage in our client services here at the Greenplate Group, we're gonna run these cash flow pro formas that I'm about to pull up. We're gonna run rental comps as well that really show the true picture of what these properties can do. And so you can see down here are real numbers that other ones are doing. All right, so I'm gonna bounce back and forth here a little bit. So here's our cash flow pro forma. All right, the property's listed at 279. And so first things first, what I wanna do is just kind of show you what's going on here. And so I'm gonna pull some numbers out of this and put it over on a white pad, but I'm putting 2750. I think there's probably, it's a new construction, there's probably a little bit of wiggle room, not a lot. I'm running it at 20% down, and that's $550,000 out of pocket, plus closing costs. Closing costs are about 2 to 3%, depending on if you're financing or if you're paying cash. There's gonna be no renovation costs because it's a brand new property. I'm gonna run it as a 30-year loan, so 360 months, and then I'm gonna run it at a 6% interest rate. So let's pull a few of these numbers out here real quick. So 2750 million is the purchase price, and then when we jump back, the down let's just call it 618 down payment. 618K is the down payment. Okay, so the first thing that everybody really looks at is the cash on cash return. Essentially, on this pro forma, you see your total cash down, and then you breaks down your monthly expenses. And so on a property like this, well, let's talk about monthly expenses first. So there is no HOA, meaning it's not in a condo complex and it's not in a regime. And so there is none of those fees. Taxes will come out to about 1.25% of the purchase price. And so I've got that down here at about $35,000 per year. Additionally, electricity, we're on a cooperative here on Hilton Head. So this big house is really only $350 a month when it comes to the electricity. Let's keep moving down here. And so cable and internet, $225, water and sewer, $150, very accurate. The pool will be $225 a month. Additionally, we get a lot of questions about flood insurance. Flood insurance, especially with newer homes, like this home that's built in the last year or so. The code is required for the property to be built higher. Because the property is built higher, you're farther off the ground, and your flood insurance is going to be a lot lower. And so for flood insurance on this, you're only looking at about $3,000 a year. And this is a completely different market than Florida. And then homeowners is about $13,000, a little bit more expensive home. We want to protect that stuff. Trash, $115 a month. You know, propane, I did put in there at $225. It's normally a pass-through cost to your guests, but that should also be in there. And then miscellaneous repairs and stuff. So I'm just budgeting about $2,500 a year. It's a brand new house. That might go up a little bit as the years go on. And so what I'm really getting at down here, here's where we put our 304 gross revenue in there. You know, I'm using a 5% management fee for self-managed. Now, if you wanted to use a rental management company, it would be 15 to 20%. If you self-manage, there are some fees associated with the platforms that you put the property on to get it booked. So net rental income before factoring out expenses is $288,800. And so what I'm not gonna get into this stuff just yet. So, you know, it's an okay cash on cash return. You're at about 9%. And so where I'm seeing cash on cash rate here is 56,215. And that's after we're taking the 288, after the 5% was taking out for some of those platform fees, or after you're taking 15% out for a rental management company. This 56,215 is the cash on cash. A lot of people that are looking at properties down here, they stop there. They say, oh, it's okay, but I don't know if I want to put, you know, $500,000 down to make 50, 60 grand a year. Let's jump back and keep our other sheet up to date. And that was 56,215. So the cash on cash is 56,215. And so that's about 9%. Okay, right? Okay, but here's where a lot of people, like I said, stop. And this is the super important way to look at these properties. It's the bundle of benefits that come. Cash flow, cash on cash is only one of them. Additionally, guys, we have about 3% per year for appreciation, factoring out inflation since 1970. We're a limited supply commodity. There's only so much of Hilton Head. And what that means is we have at least 3% per year appreciation. So that's 82,500. When you are forcing equity into these properties and you're doing renovations, that's gonna go up even higher. Let me go back here real quick. And so, again, 3%, 82,500. 82,005, it should be a 5. So 82,500, that's the 3% appreciation per year. Huge, right? Like, people don't even look at that. Let's look at the next thing. And so, guys, there's extreme tax benefits. If you are self-managing a property and you're spending at least 500 hours a year managing that property, or 100 hours more than the next person that's helping manage that property, even if you're W-2 income, you can capture bonus depreciation. And essentially, on this projection here, it's got a really rough estimate, but you're looking at about a tax savings if you did the bonus depreciation of $150,000 to $200,000 a year. That's dollar for dollar, meaning if you owed $156,000, $160,000, you would owe zero to the federal government for your income tax. But let's take a different scenario here. Let's just say we do normal straight line depreciation. Straight line depreciation is when you take the real structure of the property and divide it by 27.5. Essentially, the IRS is saying the property and the things, the physical things you have in it are gonna wear and tear over time. And so we're gonna give you tax relief from that. So you take the real structure value, and that's 1.85 million, and you divide it by 27.5, and that gives you let's just call it $67,200 a year in write-off. 67,200, 200, right? All right, so there's that. Additionally, right, somebody else is paying down your mortgage. I'm not gonna actually go into that, but a property like this, I mean, you're probably paying, you know, your tenants are probably paying, let's just call it, we'll make another one down here for mortgage pay down. Let's just say it's 10 grand, you know, simple, nothing crazy. Now, the big thing is the personal use, right? Like, people say when they buy property here, oh, either I want to use it or I don't want to use it. I'm either pure ROI or I want to offset my expenses and enjoy it. Let's just Let's look at it as first and foremost, you guys, I've had clients that tell me they're never gonna use the property. And then they're walking around in Harbor Town on 4th of July, the busiest week of the year. And I'm like, what are you doing here? I bump into them and they're like, I love it, I can't stay away. And so I grew up coming to Hilton Head with my family, and it has been nothing but amazing memories when I look back on that. And a lot of people underestimate the value of that. But let's do some simple math. Let's keep the numbers and really this formula kind of rolling. Let's say that property is $10,000 a week, right? Let's say you and your family, want to come down and use it 3 or 4 times a year. Let's say 4 times. And so at the end of the day, if you wanted to look at that from a monetary value, you're getting 40K, it's supposed to be a dollar sign, 40,000. And so essentially the way you want to look at it is, yes, you have the cash on cash return of 56,000. However, you want to add the unrealized gains together here to truly get the financials of this property. And so let's just take 82,500 plus 67,200 plus 40,000. That's the 4 weeks of the owner use. Appreciation is the 82,500. Tax benefits, straight line method, 67,000 a year. $40,000 in vacations, and let's say somebody paid down that 10K year one of your principal. And so guys, it's 199,700. Let's just call it 200. And so what you want to do here is take the 56 plus that number, the 200. Let's do that real quick. And so 56,215 plus 200,000. And really what that gives you, when you add these both up, that's 256,215 of combined cash on cash return and unrealized gain, which is the value of your coming down here and using the property. And that's outside of the season, right? The tax benefits, somebody else paying down your mortgage, as well as the appreciation. And so originally the cash on cash was 56,215. And now it might be a little bit of a stretch to take this number and divide it by the money that was put down, which was 618,000. And so if you do that though, instead of 9%, this really turns into about a 40% return on your investment yearly when you're adding all of these benefits together. And so at the end of the day here, guys, and what I really want to get helped on and help you guys on, because a lot of people don't see it, is you got to look at the big picture. You got to take the rental history with a grain of salt, right? And first and foremost, right, don't live and die by the projections and the rental history. Do your research, work with an agent that really understands what these properties can do and somebody that actually owns them in this market, right? So we're using our different softwares. Run pro formas on these, right? Ask yourself how you're gonna use it. And I think one of the most important things out of all of this is a lot of properties really do work. You can make the numbers work on a lot of properties, and it really depends how you benefit lifestyle versus how you benefit from the actual investment numbers. And you wanna weigh out your pros and your cons and everything that goes in with that. And so my final take on this property, yes, it's a 9% return cash on cash. But if you love Hilton Head and you love coming down here and making memories with your family, you can also, you might have high income, take some serious tax benefits, enjoy the long-term appreciation and wealth building of what these properties do on the island. Again, that appreciation is 82,500 every single year that you own when you average that out from historical uses. The personal use standpoint, right? Someone else paying down your mortgage, and it really comes out to that 40%. It's a good property, right? Sometimes I see some that, you can force some more equity. So I'd probably give this one 110, 7.5 out of 10, right? When you're putting that amount of cash down, a lot of people do want to see a little bit more cash on cash return. However, if you value these other things, and depending on how much you value the appreciation, tax benefits, mortgage pay down, personal use, it can really work. And that is the way we dissect properties at the Greenplate Group. That is the way you should be looking at these properties, is it's not cut and dry. There's different scenarios. How you manage it will affect it significantly, both from a total revenue number on top of saving on the percentage. And then you gotta bundle all these benefits together, and that's why these things are so hot. If you wanna jump on a short-term rental here on Hilton Head Island and work with the best team that's invested in your success, if you don't win, we don't win. Give us a call at the Greenplate Group, 843-310-0197, and we can run scenarios just like this for you and make your vacation and short-term rental investing dreams come true right here on beautiful Hilton Head Island. Thanks for tuning in, guys. We'll see you next time.